Welcome to the Deep Dive. Today we're plunging into a topic that's, well, it's the very heartbeat of any business. Cash flow.
hmm
Think of it like the lifeblood coursing through a company. And just how vital is it? Consider this. A shocking number could be up to 82% of business failures are rooted in poor cash flow management or just misunderstanding it.
That's right. It's a stark reminder, really. Even businesses with fantastic ideas, great products, maybe even solid profitability on paper,
Hmm.
they can stumble, they can fall if they don't manage their cash effectively.
Exactly. So in this deep dive, our mission, our goal, is to equip you with a foundational understanding of business cash flow, especially, as we navigate what can sometimes feel like pretty choppy economic waters.
Definitely.
We'll break down exactly what cash flow is, why it's different from revenue and profit, and that's a distinction that trips up a lot of people.
It really does.
And we'll explore the ins and outs of the cash flow statement. We'll also look at the unique challenges that economic downturns throw our way
Which are significant.
and arm you with actionable strategies. Things you can actually do for managing your cash, maybe exploring financing options, and the crucial art of forecasting and monitoring.
Our exploration today, it'll unfold in a structured way. We'll guide you through the essential aspects of cash flow management.
Okay, so first we'll be decoding cash flow itself, getting crystal clear on what it actually means and how it stands apart from revenue and profit.
The fundamentals.
Then we'll examine the three fundamental pillars of cash flow: operating, investing, and financing activities.
Right, the three main sections.
After that, we'll turn our attention to navigating that stormy weather economic downturns and the specific cash flow crises that can pop up.
Yeah, what to watch out for.
Our strategic toolkit section will hopefully equip you with practical methods to boost your cash inflows, control those all-important outflows, and, strategically consider financing if and when it's needed.
And finally,
Finally, we'll look ahead. We'll talk about the power of cash flow forecasting and monitoring to keep your business on solid financial ground. So let's get started with the basics. Decoding cash flow.
okay. So at its core, cash flow is simply the movement of money. Money moving into and out of a company over a specific period.
Just pure movement.
Exactly. It represents the net change in a company's cash and also those near cash items, what we often call cash equivalents.
Okay, like what are cash equivalents?
These are things like highly liquid short-term investments, treasury bills, maybe money market accounts, basically things you can convert to cash really quickly.
Got it. Very liquid.
Right. So cash flow tracks the actual dollars and cents flowing in and out of the business's bank accounts.
So what kind of money are we talking about coming in? What are inflows?
Okay, cash inflows. That's the money entering the business.
Mm-hmm.
The most obvious source is, of course, sales revenue from your goods or services.
Oh.
Cash sales, specifically. But it can also include things like proceeds from loans you take out, income generated from investments the company holds, money you get from selling off assets.
Like equipment you don't need anymore.
Exactly. Or even interest you receive on your bank balances. That's all cash coming in.
Okay, that clarifies things. And on the flip side, what constitutes cash outflows? Money going out.
Cash outflows are all the payments leaving the business. These are your essential operating expenses. Think salaries for your team, rent for your workspace, utility bills.
The day-to-day stuff.
Absolutely. Plus the cost of purchasing inventory or raw materials. You'll also have outflows for payments to your suppliers, repayments on your debts, the principal part, and of course taxes.
So to see the overall picture for a period, we look at the net cash flow.
Precisely. The net cash flow is just the difference. Total cash inflows minus total cash outflows over that specific period.
Simple math.
Pretty much. If your inflows are greater than your outflows, you have a positive net cash flow. Your cash balance has increased.
Good sign.
Generally, yes. If your outflows exceed your inflows, well, you have a negative net cash flow, and your cash balance has gone down. Understanding that simple calculation is really the first step.
Yeah, this is where things can get a little confusing for some folks, myself included sometimes. The difference between cash flow, revenue, and profit. Let's break that down nice and clear.
Okay, let's do it.
Revenue, often called the top line, is basically all the income a company generates from its main business activities before any expenses are taken out.
Right, before anything.
Think of it as a measure of how effective your sales and marketing efforts are. And this shows up on the income statement, right?
Correct, the income statement. And a key point here is that revenue is recorded when it's earned, which under accrual accounting, and that's the standard for most businesses, might be when you make a sale on credit, not necessarily when the cash actually hits your bank account.
Ah, okay. That's crucial, the timing difference.
Yep.
Right. Then we have profit, or
Okay.
net income,
Yeah.
often called the bottom line. This is what's left over from your revenue after you've subtracted all your business expenses.
All of them.
And all of them. The cost of the goods you sold, operating expenses, interest, taxes, and even those non-cash expenses like depreciation.
Mm-hmm.
This also lives on the income statement and gives you an idea of your overall profitability.
Well, according to accounting rules anyway.
And profit, just like revenue under accrual accounting, follows that same principle. Expenses are recognized when they are incurred, not necessarily when the cash goes out the door.
Okay.
And this is where the divergence with cash flow really starts to become clear. Cash flow, as we've said, is the actual movement of physical, well, digital these days, cash. It's tracked on a completely different financial statement, the cash flow statement.
Okay, so the timing and those non-cash items,
Sure.
those are the big differentiators. Can you give us some concrete examples to make it really stick? Absolutely. Let's say you make a big sale on credit, $100,000. Great. Your revenue goes up on your income statement. Your profit probably goes up too, assuming you've accounted for the cost of that sale.
It's good on paper.
Right. But you haven't actually received any cash yet. That $100,000 your customer owes you, it sits on your balance sheet as something called accounts receivable, or AR.
Okay.
Now, a high accounts receivable balance might look impressive in terms of sales volume, but it doesn't help you pay this month's rent or payroll if the cash isn't there.
I see your point. So high sales don't automatically equal a healthy bank balance? Makes sense.
Yeah.
What's another example?
You think about buying inventory. Maybe you run a shop. You spend, say, $10,000 cash to stock up on goods. That's a cash outflow, right? Money left your account.
Yep, cash is gone.
But that expense, that $10,000, doesn't immediately hit your profit on the income statement. It only becomes part of your cost of goods sold, or COGS, when you actually sell that inventory.
Ah, okay. So the cash impact is now, but the profit impact is later.
Exactly. See the mismatch.
Got it. What about debt? Paying back loans.
Good one. When you repay the principal amount on a loan, the actual borrowed sum that's clearly a cash outflow, money leaves your account,
Definitely.
but it doesn't reduce your profit. Only the interest you pay on that loan is considered an expense on your income statement. The principal repayment itself is just reducing your liability, the amount you owe, which you see on the balance sheet.
Okay, so paying down debt uses cash, but doesn't hurt your reported profit for that period.
Interesting. And you mentioned non-cash expenses like depreciation. How did those play into this?
Depreciation is a really important one to grasp. It's an accounting expense recorded on your income statement.
Yay.
It reflects the gradual wear and tear or the using up of your long-term assets over time, machinery, buildings, vehicles.
Assets lose value.
So it lowers your reported profit, which lowers your taxes, which is good. Here's the key. There's no actual cash leaving your business in that period, specifically due to depreciation.
The cash outflow happened way back when you originally purchased that asset. Depreciation is just allocating that initial cost over the asset's useful life on paper.
I see. So it's an accounting entry, not a cash transaction in the current period.
Precisely. And things like amortization of intangible assets, like patents or goodwill write-offs, work similarly. They reduce your profit but don't involve a current cash payment.
So the big takeaway here, the really crucial point, is that a company can look really profitable on paper, great
Yeah.
income statement,
Yeah,
but actually be strapped for cash.
absolutely.
And I guess maybe less common, but vice versa too. Could you have good cash flow but low profit?
You could, yeah. Maybe you collected a lot on past receivables or sold an asset for cash or took out a loan. That boosts cash but might not correspond to current period profit. But
Right.
the more dangerous situation is definitely being profitable but cash poor.
Right, because profitability doesn't guarantee you have the liquid funds, the actual cash, to pay your immediate bills, payroll, suppliers, rent.
Exactly. Cash flow is the real indicator of your liquidity, your ability to meet those short-term obligations.
So relying solely on profit figures can be misleading. You might make a big decision based on seemingly high accrued revenues, only to realize you don't have the cash in the bank to actually, say, pay for the supplies needed to fulfill those orders. That could lead to a real crisis.
That's the trap. Positive cash flow is what enables a business to actually function day to day and ultimately to thrive.
So why is that consistent positive cash flow so crucial? What does it allow a business to do?
Well, positive cash flow is really the foundation of financial stability. It gives you the resources, the actual money, to meet your day-to-day obligations, paying operating expenses, keeping your employees paid, settling up with suppliers, making those all-important loan payments. That's table stake.
Just keeping the engine running.
Right. But it also fuels reinvestment and growth. You need cash to fund research and development, R&D, to buy new equipment, to expand your operations, or maybe launch new products.
And it goes beyond just keeping the lights on and growing, right? What about owners in debt?
Absolutely. Positive cash flow allows you to reward your owners or shareholders, maybe through dividends or stock buybacks. It enables you to reduce your debt, which lowers your future interest costs and strengthens your financial position overall.
Makes the company less risky.
Definitely. And crucially, it helps you build a safety net. Those vital cash reserves that can help you weather unexpected challenges, a sudden downturn, a big customer leaving, or seize new opportunities that might pop up.
Like acquiring a competitor or investing in new tech.
Exactly. Ultimately, positive cash flow reflects your company's liquidity, its ability to pay its bills, and its financial flexibility, its capacity to adapt and grow. Consistently strong cash flow, especially from operations, gives a business significant strategic flexibility. It allows for reinvestment, funding acquisitions, maybe without heavy debt, and weathering market shifts with much greater confidence.
Okay, so understanding the vital role of consistent positive cash flow brings us to the crucial question. How do we actually see this? How do we analyze where that money is going and coming from within a business? That's where the cash flow statement comes in, I assume?
That's exactly where the cash flow statement, or a CFS, comes in. It's the formal financial report. It details all the cash that has flowed into and out of a company over a specific accounting period, usually a quarter or a full fiscal year.
And you said public companies have to file this?
Yes, publicly traded companies are required by regulators like the SEC in the U.S. to file a CFS along with their income statement and balance sheet.
And you mentioned it bridges the gap between the income statement and the balance sheet. How does that work practically?
Think of it this way. The income statement shows you profitability based on that accrual accounting method we discussed, recognizing revenue when earned, expenses when incurred.
Right.
The balance sheet gives you a snapshot, like a photo, of what a company owns assets and owes liabilities and equity at a specific point in time. The cash flow statement takes those accrual-based profit figures from the income statement and essentially reconciles them. It adjusts for all those timing differences and non-cash items, like depreciation or changes in accounts receivable, to show the actual cash generated or used during the period.
So it connects the profit number to the change in the cash balance on the balance sheet.
Precisely. It's like a reality check on those profit numbers. It reveals if the reported earnings are actually translating into the tangible cash a business needs to survive, operate, and grow.
Makes sense. So what are the main sections we look at on a typical cash flow statement?
The CFS is usually divided into three main parts, and these reflect the core activities of pretty much any business. They are cash flow from operating activities, cash flow from investing activities, and cash flow from financing activities.
Operating, investing, financing.
Okay. And the sum of the cash flows from these three sections, positive or negative, equals the net increase or decrease in the company's cash and cash equivalents for that period. Add that to the starting cash balance, and you get the ending cash balance.
Okay, so we've laid the groundwork. We understand what cash flow is, why it's different from profit, and where we find this info. Now let's dive deeper into those three pillars: operating, investing, and financing activities.
Right. The cash flow statement neatly categorizes all cash movements into these three distinct types of activities. Understanding each category is really crucial for analyzing a company's financial health and, its future prospects.
Let's start with cash flow from operations, often abbreviated as CFO or OCF. What does that tell us?
Cash flow from operations, or OCF as it's often called, focuses on the cash generated from or used in a company's main day-to-day business activities, the things that actually produce revenue.
Core business.
Exactly. This section is really the heart of the CFS because it shows how well a company can generate cash from its fundamental business model. It excludes those longer-term investing decisions and how it's funding itself through debt or equity.
So what kind of cash is typically flowing in from operations? What are the OCF inflows?
The most common inflows here are, obviously, cash you receive directly from selling your goods or services to customers. Cash sales.
Okay.
It also includes the cash you collect on your accounts receivable, those payments finally coming in for previous credit sales. You might also see interest received and dividends received here. Although, it's worth noting, sometimes those are classified under investing activities. Depends on the company and accounting standards.
Ah, okay. Bit of variation there.
A little bit. Refunds you receive from suppliers or cash you get from lawsuit settlements or insurance payouts that are directly related to your core operations would also fall into this category.
Okay, and what about the cash that flows out through operating activities, OCF outflows?
Common operating cash outflows include payments you make to your suppliers for the goods, services, inventory, and raw materials you need to run your business.
Paying your bills.
Right. Employee salaries, wages, and benefits are usually a big one here. Then you have your general operating expenses like rent, utilities, insurance, marketing costs. Income tax payments are also included here. And similar to interest received, sometimes the interest paid on loans is classified under operating activities, though sometimes it's under financing.
Okay, another potential variation.
Yeah.
So what's a big takeaway when we look at a company's operating cash flow? What are we really looking for?
A consistently positive OCF is a really strong signal of financial health. It tells you that the company's fundamental business is generating enough cash to keep running, cover its costs, and maybe even fund some growth or reduce debt,
Yeah.
all without needing to constantly rely on outside financing or selling off its assets.
Self-sustaining.
Ideally, yes. On the other hand, if you see a consistently negative OCF, that raises some serious red flags about the long-term viability of the business model. It suggests the company might be burning through cash just to stay afloat.
Needs cash from elsewhere just to operate.
Exactly. So generating positive cash flow from its core operations is just essential for a business to be sustainable over the long haul.
That makes perfect sense. Now let's move on to the second pillar. Cash flow from investing, or CFI. What does that encompass?
Cash flow from investing, or CFI, tracks all the cash movements related to buying and selling long-term assets, things like property, plant, and equipment, or PP&E. It also includes other significant investments that aren't considered those near cash equivalents we talked about.
So not short-term stuff.
Right. These are the kinds of activities that reflect a company's strategies for growth and expansion, because these assets are typically expected to generate value over several years.
Okay, so what are some typical cash inflows from investing activities? Money coming in from investments.
Here you'll see things like the proceeds, the cash from selling off property, plant, and equipment. Maybe they sold an old factory or some machinery.
Okay.
If the company sells investments in securities it holds, like stocks or bonds of other companies, that cash received would also be an investing inflow. If they've made loans to other entities in the past and are now receiving principal repayments on those loans, that's another CFI inflow. And finally, if they sell off entire business segments or subsidiaries, the cash they get from that sale generates an inflow in this section.
Got it. And what about the cash outflows related to investing? Where does the money go?
The biggest outflow you'll usually see here is for purchases of property, plant, and equipment, PP&E. This is often referred to as capital expenditures, or CapEx.
Buying new buildings, machinery?
Exactly. Investing in the future productive capacity. Buying investment securities in other companies is another cash outflow. If the company is making loans to other entities, that's also an investing cash outflow.
Lending money out.
Right. And of course, when a company acquires another business, the cash paid for that acquisition falls under investing activities. It's a major investment. Interestingly, spending on research and development, R&D, can sometimes be classified here too, depending on the specific accounting treatment and rules.
So how do we interpret the cash flow from investing section? Is positive or negative necessarily good or bad here? It sounds different from operating cash flow.
It is different. Unlike operating cash flow, where positive is generally good, a negative CFI isn't always a bad sign. In fact, for companies that are focused on growth, maybe a young tech company or a business expanding rapidly, you'd often expect to see a negative CFI.
Because they're spending money.
Exactly. They're likely investing heavily in their future productive capacity, buying new equipment, building facilities, making strategic acquisitions. That costs cash up front.
So negative CFI can mean investment in growth. What about positive CFI?
While positive CFI means they're selling off more long-term assets than they're buying, a bit of that is normal, but consistently high positive CFI, especially if it's coming from repeatedly selling off major long-term assets, might raise concerns.
Why is that?
It could suggest the company is maybe divesting core parts of its business just to generate cash, or perhaps it's facing liquidity issues and needs to sell assets to cover operating shortfalls. It warrants a closer look.
That makes sense for a startup aggressively investing in its future, showing negative CFI. But what about a more established, mature company? If they show consistently large negative investing cash flow year after year, wouldn't that raise some concerns eventually?
Yeah.
Like, are those investments paying off?
That's a very insightful question, yes. For a mature company with consistently high negative CFI, it could indeed signal potential problems down the line. It might indicate they are perhaps overinvesting in assets that aren't generating sufficient returns. Maybe they're making acquisitions that aren't strategically sound or are proving harder to integrate than expected.
Or just spending inefficiently?
Potentially. It's definitely something an analyst would dig into further. They'd want to understand the reasons behind that continued high level of investment spending and whether it's actually creating value.
Okay, that's helpful context. Now let's talk about the final pillar, cash flow from financing, or CFF. What does that tell us?
Cash flow from financing, CFF, details all the cash that flows between a company and its owners, the shareholders, and its creditors, the lenders, like banks or bondholders.
So, how the company gets its capital.
Exactly. This section really shows how a company raises the capital it needs to fund its operations and growth, and also how it returns capital to its investors or repays its debts. Analyzing CFF gives you insights into a company's financial structure, how much debt versus equity it uses, its dividend policy, and its overall financial strength and relationships with its capital providers.
Okay, so what are some common cash inflows from financing activities? Money coming in.
The primary inflows here are the proceeds, the cash a company receives from issuing new equity, basically selling new shares of its stock to investors.
Raising money from shareholders.
Right. And the other major inflow is proceeds from issuing debt, borrowing money through new loans, or by issuing bonds.
Taking on new debt. Okay, and what about the cash outflows in this financing section?
Common financing cash outflows include the repayment of the principal on debt when the company pays back the original amount of its loans or bonds. Remember, the interest paid might be in operating or financing, but the principal repayment is always financing. If a company repurchases its own stock, sometimes called a stock buyback, buying shares back from the open market, that's also a financing cash outflow.
Returning cash to shareholders that way.
Yes. And finally, any cash dividends that are paid out to shareholders would be recorded here as a financing outflow.
Okay. So how do we interpret the cash flow from financing section? What does positive or negative CFF usually mean?
A positive CFF generally means the company has raised more cash from financing activities, issuing stock or debt, than it has paid out during that period for things like debt repayment or dividends.
So more money came in from lenders investors than went out.
Right. This could happen if they've taken on significant new debt or issued a lot more stock, perhaps to fund a major expansion, a large acquisition, or maybe because their operating cash flow wasn't sufficient to cover their needs.
And negative CFF.
A negative CFF indicates the company is using cash to pay down its debt principal, buy back its shares, or distribute profits as dividends. More cash is flowing out to owners and creditors than is coming in from them.
Is negative CFF generally seen as a good thing?
It can be. Repaying debt strengthens the balance sheet. Returning value to shareholders through dividends or buybacks can be a sign of a healthy, mature company generating excess cash. However, you also have to consider the context. Consistently high positive CFF, especially if it's primarily from taking on more and more debt year after year, might suggest the company is becoming too reliant on external funding rather than generating enough cash from its core operations.
Could lead to a heavy debt burden.
Exactly. It could become unsustainable down the line if operating cash flow doesn't improve.
It really sounds like looking at all three sections, operating, investing, and financing together, gives you a much richer, more complete understanding of a company's overall financial health and strategy.
Absolutely. You can't just look at one in isolation. The way these three sections interact can reveal a lot about a company's strategic direction and even where it is in its business life cycle.
Can you give an example?
Sure. Think about a young, high-growth startup. It might have negative operating cash flow initially because of high startup costs and investments in building the business. It would likely have significant negative investing cash flow as it buys essential assets, develops technology, and builds infrastructure.
Spending a lot to get going.
Right. But it would probably have strong positive financing cash flow as it raises capital from venture capitalists or takes out initial loans to fund all that activity.
Makes sense.
Yeah.
What about a more mature company?
A more mature, stable company, maybe a blue-chip firm, might look very different. It would likely show strong, consistent, positive operating cash flow from its established business. It might have moderate negative investing cash flow, mainly for maintaining and replacing existing assets rather than massive expansion.
Okay. Keeping things running.
And it might have negative financing cash flow as it uses its strong operating cash to systematically repay debt and return profits to shareholders through regular dividends or maybe stock buybacks. Seeing these different patterns gives you a much deeper understanding than just looking at the profit number or only one section of the CFS.
That's incredibly insightful. It really paints a picture. And just to recap for everyone listening, we have a helpful table in our show notes summarizing these common cash inflows and outflows by activity type, operating, investing, financing, and noting again that the classification of things like interest and dividends can sometimes vary a bit.
Yes, it's a useful reference to keep handy. Now that we have a good handle on the 3 pillars of cash flow, let's shift our focus. Let's talk about how economic downturns, those stormy times, can really impact these flows and what specific challenges businesses might face then.
Right, because the overall economic climate can have a huge effect on a company's cash situation. It's not just internal factors. So let's talk about navigating those stormy economic waters. First off, what exactly constitutes an economic downturn or a recession? We hear those terms a lot.
Yeah, they get thrown around. Economic activity, as you said, naturally goes through cycles, periods of expansion followed by periods of contraction. A recession is generally understood as a significant, widespread, and prolonged decline in economic activity across the economy.
Not just a blip.
Not just a blip. While there's no single, universally agreed upon definition, a common technical benchmark, especially in the U.S., is 2 consecutive quarters, that's 6 months of negative growth in country's gross domestic product, or GDP.
Okay, 2 quarters of shrinking GDP.
Right. But more broadly, during a recession, you typically see decreases in overall economic output, a noticeable rise in unemployment rates, and a significant drop in consumer spending and business investment. Things just slow down considerably.
And what are some of the common triggers? What can actually cause these recessions?
Several factors can set off a recession, and sometimes it's a combination. You can have supply shocks. Think about a sudden disruption in the availability of essential goods, like oil, maybe due to a war or a natural disaster. That can drive up prices and really hurt production.
Okay, supply-side problems.
Then you have demand shocks. These are events that make consumers and businesses suddenly less willing or able to spend and invest. Maybe a financial crisis causes widespread fear, or a pandemic hits.
People pull back.
Exactly. Sometimes policy missteps by governments or central banks can play a role. Maybe interest rates are raised too quickly or too high, or government spending is cut too drastically at the wrong time.
Unintended consequences.
Could be. Financial crises themselves, where there's widespread instability in banks or financial markets leading to a severe tightening of credit, are another major trigger. Think 2008. And finally, the bursting of asset bubbles, like a sharp, sudden decline in housing prices after a period of rapid increase, or a stock market crash, can also ripple through the economy and lead to a recession. Whatever the specific cause, these downturns create a much more uncertain and financially pressured environment for most businesses.
Absolutely. And it sounds like in that kind of environment, effective cash flow management becomes even more critical, just paramount for survival.
Crucial. Absolutely critical.
So what are some of the common cash flow crises, the specific problems that businesses tend to experience during recessions?
During a recession, businesses often face a painful double whammy. Their cash inflows tend to shrink, sometimes dramatically, while at the same time, the pressures on their cash outflows often increase. It's a real squeeze.
Okay, break that down. Reduced inflows first.
Right. One of the most immediate and widespread impacts is simply reduced sales and revenue. As consumers get worried about their jobs or see their incomes fall, and as other businesses face their own uncertainties, they tend to cut back on spending, especially discretionary spending.
Things people don't absolutely need.
Exactly. So industries like retail, restaurants, tourism, entertainment, they often feel the pinch particularly hard and fast. But even businesses providing essential services can see an impact as their clients face their own financial difficulties and maybe delay projects or look for cheaper alternatives. So less money coming in the door from sales.
That makes sense. People tighten their belts across the board. What's another common cash flow challenge related to inflows?
Slower collections from customers and a rise in bad debt. This is a huge one. When your customers, whether they're individuals or other businesses, are facing financial hardship, they often start delaying paying their bills.
Stretching out payments.
Right. This slowdown in collecting your accounts receivable directly impacts your cash inflows, even if you're still making sales on paper. And worse, the risk of customers defaulting entirely on their payments, what we call bad debt, increases considerably during a downturn, especially if your customers are other businesses that might be struggling or even facing bankruptcy.
So even if you made the sale, you might get the cash much later. Or maybe never.
Exactly. It's a serious impediment to cash flow.
That sounds like a real squeeze. What about getting outside help? Access to funding. Does that change?
Oh, definitely. Access to credit often becomes much tighter and more expensive during a recession. Lenders, like banks and other financial institutions, naturally become more cautious and risk-averse when the economy looks shaky.
They get nervous too.
They do. They tend to tighten their lending standards, making it harder for businesses to get approved for new loans or even to draw on existing lines of credit they might have. And the interest rates on any available credit are likely to be higher.
So more hurdles, higher cost.
Right. This is particularly tough for small businesses, which might have fewer assets to pledge as collateral or less established credit histories compared to large corporations. When this critical safety net of external financing becomes harder to reach or more costly, it can really exacerbate cash flow problems just when businesses need help the most.
Okay, so we've got reduced sales, slower payments, and difficulty getting loans. What else can go wrong with cash flow during a downturn? Are there issues with costs or supplies?
Yes, absolutely. Supply chain disruptions can also become a major issue. Economic instability, maybe combined with global events, can create ripple effects throughout complex supply chains. This can lead to delays in getting the materials or components you need for your own production.
Can't make a product if you don't have the parts.
Precisely. This can halt your production, which then delays your sales and your cash inflows. It can also increase your costs if you're forced to find more expensive alternative suppliers or pay for expedited shipping. So supply chain issues can impact both when your cash goes out, maybe needing to pay suppliers earlier or at a higher price, and when your cash comes in if your sales get delayed as a result.
A double hit there potentially. And I imagine operating costs don't necessarily just go down in a recession, do they? Sometimes they might even go up.
Unfortunately, yes, that can definitely happen. Downturns are sometimes preceded or accompanied by periods of inflation, where the cost of your raw materials, energy, labor, and other essential operating expenses goes up. That means more cash going out just to maintain the same level of operation.
Paying more for the same stuff.
Right. And at the same time, central banks often raise interest rates to combat that inflation, which might have even contributed to the downturn. Those rising interest rates increase the cost of servicing any variable rate debt your business might have, lines of credit, some loans. So your debt payments suddenly cost more cash each month, putting even more strain on your outflows.
Wow, it really does sound like a perfect storm of financial pressures. Reduced inflows, potentially increased outflows.
Yeah.
Are there maybe a couple more specific cash flow crunch points common during a recession?
Yes, a couple more are worth mentioning. Inventory issues can become a big headache. If your sales slow down unexpectedly, which is common in a recession, you can quickly end up with excess inventory piling up in your warehouse or on your shelves.
Stuff you can't sell.
Exactly. And that unsold stock represents cash that you've already spent to produce it or acquire it just sitting there, not generating revenue. Plus, it incurs additional holding costs like storage, insurance, and maybe even financing costs if you borrowed to buy it. And there's always the risk that it might become obsolete or spoil before you can sell it.
So cash is tied up, and it costs money to keep it.
Right. And finally, think about pricing pressure. In a recession, competition often intensifies for a smaller pool of customer spending. This frequently puts pressure on businesses to cut their prices just to maintain sales volume and keep some revenue coming in.
Race to the bottom sometimes.
It can feel like that. While price cuts might be necessary for survival in the short term, they inevitably erode your profit margins and reduce the amount of cash you generate from each individual sale, making it harder to cover your fixed costs.
So less cash per transaction. It all adds up. It sounds like a really, really challenging environment. And you mentioned earlier the psychological impact of a recession can make things even worse.
That's absolutely right. The widespread fear and uncertainty that permeate the economy during a recession often lead to more cautious behavior across the board, creating a kind of negative feedback loop.
How so?
Well, consumers get nervous about their jobs and their financial futures, so they postpone making major purchases or even cut back on small ones. Businesses become hesitant to invest in new projects or hire new people, and they might start hoarding cash just in case.
Building up reserves.
Exactly. And as we've discussed, lenders become more strict with their lending criteria, making credit harder to get. This collective caution consumers spending less, Businesses investing less, banks lending less can dampen economic activity further, making the cash flow crunch even more severe for everyone.
It feeds on itself.
It really can. So successfully navigating a recession requires more than just smart financial adjustments within your own company. It also demands careful management of your key relationships and maintaining open, honest communication with your customers, your suppliers, and your lenders. Building trust becomes even more important when times are tough.
It sounds like businesses really need a solid plan of attack, a toolkit to weather these economic storms. So let's move on to that strategic toolkit. What are some key strategies businesses can actually employ to improve their cash flow when times get tough?
Okay, yeah. When facing those economic headwinds, businesses absolutely need to be proactive in managing their cash flow. You can't just wait and see. This really means focusing intensely on two main areas: finding ways to boost the cash that's coming into the business and implementing measures to tightly control the cash that's going out.
Inflows up, outflows down, or at least controlled.
That's the goal. Now, while external financing might become necessary in some situations to bridge a gap, it should really be viewed as a strategic, temporary tool, not a long-term solution for fundamental problems.
Not a crutch forever.
Right. And a really important piece of advice here is to try and establish access to credit, like that line of credit we discussed before a crisis hits. Your options tend to become much more limited and certainly more expensive when you're already visibly struggling.
Get your umbrella before it starts raining.
Exactly. Perfect analogy.
Okay, let's start with boosting those cash inflows. What are some effective, practical ways to get cash into the business more quickly? Accelerate collections.
Yes. Accelerating your accounts receivable collection, getting paid faster for the goods or services you've already delivered, is one of the most direct ways to improve inflow. And there are several methods you can use here. First, make sure you're invoicing promptly and clearly. Don't delay sending out those bills.
Don't let them sit on your desk.
Right. Issue them as soon as the work is completed or the goods are shipped. For larger projects, consider milestone billing or maybe monthly progress billing instead of waiting until the very end. And ensure your invoices themselves are accurate, easy to understand, and clearly state the amount due, the due date, all the accepted payment methods, and any relevant terms like early payment discounts or late payment penalties.
Make it easy for them to know what to pay and when.
Precisely. And using digital invoicing systems, if you're not already, can really streamline this process, reduce errors, and often speed up delivery to the customer.
That clarifies things. The sooner they get the bill, hopefully the sooner they can process it. What else can businesses do around their invoicing and terms?
You should also actively review and optimize your payment terms. Clearly define your standard payment terms, maybe it's net 30, net 15, whatever fits your industry right from the start in your contracts, and reiterate them on every invoice.
Consistency.
Yes. Now, during tougher economic times, you might need to consider tightening those standard terms, especially for new clients, perhaps requiring payment upon receipt or moving from net 30 to net 15.
Be a bit stricter.
Potentially, yes. But for your existing reliable customers who you know are facing temporary difficulties, maybe offering a structured payment plan could be a better approach. It helps you ensure you eventually get paid while preserving that valuable long-term relationship.
Finding a balance.
Exactly. And another tactic is requiring deposits or significant upfront payments, especially for large orders, custom work, or new customers. This helps secure some initial cash flow and reduces your risk if the customer cancels or defaults later.
Get some skin in the game up front. What about encouraging faster payment? Are there any tactics there besides just setting shorter terms?
Absolutely. Incentivizing early payment can be very effective, especially when your customers might also be managing their own cash flow tightly. The classic approach is offering a small discount, say 1% or 2% for payments made significantly before the due date.
Like the 210 net 30 term.
Exactly. That means the customer can take a 2% discount if they pay within 10 days. Otherwise, the full amount is due in 30 days. Now, while this does slightly reduce the total revenue you receive per invoice,
You get less money overall.
you get the cash much, much faster, which might be more valuable right now. There are different types of discount structures you could explore too, maybe a sliding scale where the discount decreases as the due date gets closer, or even dynamic discounts negotiated individually. The key is to offer a discount that's genuinely valuable enough to your customer, making it worthwhile for them to prioritize paying you early compared to their other options or their own cost of capital.
Discounts are always appealing, especially if cash is tight for them too. Now, what about when payments inevitably become late? What's the process then?
You need a systematic follow-up process. Don't just wait until an invoice is 30 days past due. Consider implementing polite, automated reminders that go out shortly before the due date as a gentle nudge.
A pre-reminder.
All right. Then, once an invoice actually becomes past due, follow up promptly and persistently. Don't let it slide. Prioritize your follow-up efforts based on how old the debt is and the size of the outstanding amount. Focus on the biggest and oldest ones first.
Go after the low-hanging fruit or the biggest impact.
Makes sense. Consider implementing late payment fees or interest charges, but, and this is crucial, make sure these potential penalties are clearly stated upfront in your initial agreements and on your invoices. You can't just spring them on customers later.
Transparency is key.
Absolutely. There are also many software tools available now that can help automate these reminders and track your collection efforts, making the process more efficient. And for debts that become significant or persistently overdue despite your efforts, you might unfortunately need to consider escalating it, perhaps by using a reputable third-party debt collection agency, though that comes with its own costs and potential relationship impacts.
Right, that's usually a last resort.
Mm-hmm.
And making it physically easy for people to pay seems like a simple win.
It really is. Simplify the payment process as much as possible for your customers. Remove any friction. Offer a variety of convenient electronic payment options. Think ACH bank transfers, credit and debit cards, online payment portals integrated with your invoicing software.
Meet them where they are.
Exactly. Online payments are often faster, they provide better tracking, and they can significantly reduce your administrative burden compared to handling paper checks.
Fewer trips to the bank. Makes sense. Finally, when it comes to getting cash in the door from sales, what about managing who you're extending credit to in the first place, especially during uncertain times?
This is a critical proactive step. Before you agree to extend credit, which essentially means offering payment terms other than cash upfront, you should seriously consider conducting credit checks on new customers, particularly if they're placing large orders.
Know who you're dealing with.
Yes. Review their credit reports, check their trade references if possible. For customers with a documented history of poor credit or slow payments, you might need to adjust your standard approach. Maybe require cash payment upfront, ask for a larger deposit, or perhaps set higher interest rates if you do decide to offer them credit terms to compensate for the increased risk.
Price and the risk.
Right. It's also a really good practice to regularly monitor your account's receivable aging reports. This shows you how long your invoices have been outstanding. It helps you identify slow-paying or high-risk customers early on so you can potentially adjust their credit limits or your collection strategy before the problem gets too big.
Stay on top of it.
Yeah.
Okay, those are some really great actionable strategies for boosting inflows. Now let's flip the coin. Let's talk about controlling cash outflows. Where should businesses focus their efforts on reducing or managing spending when cash is tight?
Okay, controlling outflows. When cash is scarce, you need to become laser-focused on managing and, where possible, reducing your cash outflows. A really good starting point is strategic expense reduction.
Strategic, not just random slashing.
Exactly. First, you need visibility. Closely monitor and track all your spending. Categorize your expenses meticulously so you understand exactly where your money is going. Use budgeting tools, compare actual spending to your budget regularly. Then, once you have that clarity, aggressively identify and eliminate or significantly reduce any discretionary spending.
Define discretionary spending. What falls into that bucket?
Discretionary spending covers those costs that aren't strictly necessary for your core operations or for generating immediate revenue. Think about things like unused or redundant software subscriptions. Audit those regularly.
Software bloat.
Definitely. Excessive business travel, maybe you can substitute virtual meetings much more often now. Lavish employee perks, expensive company parties, or elaborate team outings are often areas where you can scale back significantly without hurting the core business.
Maybe less fancy coffee.
Could be. Office aesthetics, expensive furniture, premium snacks or supplies might be another place to find savings. Certain marketing campaigns that, upon review, aren't delivering a strong, measurable return on investment, ROI, could be paused, or maybe non-critical training programs could be deferred. It requires taking a hard look at everything.
It sounds like you need to be really smart, really surgical about where you make these cuts. You don't want to cut off your nose to spite your face, right?
Absolutely. You need to be very strategic. Prioritize your potential cuts based on the impact they'll have on your operations versus the actual cash savings they'll generate. Critically, avoid slashing expenses that directly drive revenue, like firing your best salesperson or stopping essential marketing activities that bring in leads, because that could actually worsen your cash flow problem in the medium term, by choking off your inflows.
Cutting muscle instead of fat.
Precisely. The goal here is to become lean and efficient, not to cripple your ability to operate or your future potential. And remember, this shouldn't be a one-time exercise. You should continuously reassess your expenses. Costs that seemed essential 6 months ago might become discretionary in tougher times. Actively look to renegotiate contracts with your vendors, your landlord, your service providers. Can you get better rates or more flexible terms? Shop around aggressively for cheaper alternatives for things like office supplies, insurance, or even utilities. Every dollar saved contributes to improving your cash position.
That continuous review is key. Now, another big area for cash outflow, especially for businesses selling physical products, is inventory. How can businesses manage that more effectively during a downturn to free up cash?
Smart inventory management becomes absolutely crucial when cash is tight. Holding too much inventory ties up a huge amount of cash that could be used elsewhere. And don't forget, it also incurs ongoing carrying costs, storage fees, insurance, potential spoilage or obsolescence, the cost of capital tied up.
It's not free to just sit there.
Not at all. The goal is to find that delicate balance where you have enough stock on hand to meet anticipated customer demand without significantly overstocking and tying up unnecessary cash. You should regularly analyze your inventory turnover ratio, how quickly are you selling through your stock, to see how efficiently you're managing it.
Identify the slow movers.
Exactly. Identify any slow-moving or potentially obsolete items and take action to liquidate them. Maybe offer discounts, bundle them with faster-selling products, run a promotion, whatever it takes to convert that stagnant inventory back into cash, even if you have to accept a reduced profit margin on those items. It's often better than letting them gather dust indefinitely.
Get something rather than nothing.
Right. And focus your purchasing and stocking efforts on your high-demand, fast-turning items, your winners. There are also various inventory management techniques you can employ. You might hear terms like just-in-time, JIT ordering, where you aim to receive goods from suppliers only as they are needed for production or sale, minimizing your holding costs.
A lean inventory.
Very lean. Other methods include calculating the economic order quantity, EOQ, to find the most cost-effective order size, using ABC analysis to categorize your inventory based on value, focusing management effort on the high-value A items, and using accounting methods like FIFO, first in, first out, or LIFO, last in, first out, for valuation and management.
Lots of tools there.
Definitely. And leveraging technology like dedicated inventory management software can be incredibly valuable. It helps you track your stock levels accurately in real time, forecast demand more effectively based on historical data and trends, and even automate reordering processes to help you optimize your inventory levels and reduce manual effort.
Automation can really help optimize. Okay, that makes sense for inventory. What about those big, infrequent purchases? Capital expenditures, like buying new machinery or vehicles. How should businesses approach those when cash is tight?
Yeah, managing capital expenditures, or CapEx, becomes critical during economic downturns or cash crunches. These are typically large investments in long-term physical assets. One key strategy is to consider leasing major assets instead of buying them outright.
Renting versus owning, basically.
Essentially, yes. Leasing equipment, vehicles, or even real estate usually requires smaller, regular payments spread out over time, rather than a massive upfront purchase price that consumes a huge chunk of your cash.
Preserve that upfront cash.
Exactly. Preserving cash is paramount in a downturn, even if leasing might end up being slightly more expensive over the very long life of the asset. Plus, lease payments are typically tax-deductible as an operating expense, and leasing can help you avoid the complexities and costs associated with upgrading or eventually selling owned equipment. Some lease agreements might even include maintenance costs, which simplifies budgeting.
So leasing is an option. What if you really feel you need to acquire an asset?
If you do need to acquire assets, you need to prioritize ruthlessly. Critically evaluate any planned CapEx projects and consider deferring or even canceling any non-critical investments, those that aren't absolutely essential for your immediate operations, safety, or maybe regulatory compliance.
Focus on the must-haves, not the nice-to-haves.
Precisely. Focus your limited resources on what's called maintenance CapEx, the spending required just to keep your existing essential assets functioning properly and safely. Postpone the growth CapEx if possible.
To keep the current machinery running before buying new shiny stuff.
That's the idea in a crunch. If you do have remaining capital expenditure projects that seem necessary, reevaluate them rigorously. How well do they align with your core business strategy right now? What's their realistic potential return on investment, ROI? And how urgent are they really? Interestingly, though, a downturn can sometimes be a strategically good time to plan and prepare for future strategic investments, perhaps getting designs ready or securing permits, positioning your company for a stronger recovery when conditions improve. And don't forget to explore alternatives to buying brand new. Could you lease instead? Or could you purchase reliable used equipment, which can significantly reduce your upfront cash outlay?
Good points, thinking creatively. Okay, one more major area of outflow is payments to suppliers' accounts payable. Are there ways to manage those outgoing payments more effectively to help cash flow?
Absolutely. Managing your accounts payable, or AP, strategically is a key lever you can pull. One of the most effective tactics here is to try and negotiate more favorable payment terms with your suppliers.
The flip side of managing accounts receivable.
Exactly. Try to extend your payment deadlines. For example, could you ask for net 60 or even net 90 days instead of your current net 30 terms? This allows you to hold on to your cash for a longer period, essentially giving you a short-term, interest-free source of working capital financed by your suppliers.
Using their money for longer.
Put simply, yes. Now, your success in negotiating this often depends heavily on the strength and history of your relationship with that supplier and your relative bargaining power. Open, honest communication is vital. Be transparent about your situation if you're facing temporary difficulties. Many suppliers may be willing to work with a reliable long-term customer because they have a vested interest in your survival too. They want your future business.
It's a partnership.
Ideally. When you're negotiating, try to frame your requests in a way that might offer mutual benefit, if possible. For instance, could you offer to commit to larger future order volumes or a longer-term contract in exchange for more payment flexibility right now?
Give them something in return.
Right. Even if you can extend terms, at a minimum, manage your payment timing carefully. Pay your bills on their due date, but not necessarily the moment you receive the invoice, unless there's an attractive early payment discount that makes financial sense for you to take. Using electronic payment methods like ACH can also help you time your payments precisely and maximize the time your cash stays in your account before being transferred. And make sure you prioritize your payments. Pay your most critical vendors first, those whose supplies or services are absolutely essential for your operations or revenue generation. You can't afford to have them cut you off.
Don't bite the hand that feeds you.
Well put. And one other idea, particularly for smaller businesses, is to explore joining buying cooperatives or group purchasing organizations with other similar businesses. This allows you to pool your purchasing power and potentially negotiate better prices or terms from suppliers due to the larger volume.
Strength in numbers. Okay, this is a great list of inflow and outflow strategies. But it sounds like there can be a bit of a tension, a delicate balance to strike sometimes, like pushing customers hard while asking suppliers for leniency.
You're exactly right. There absolutely is a balance. For instance, aggressively pushing your customers for faster payments while simultaneously trying to significantly extend your own payment terms with your suppliers can definitely strain those crucial business relationships if you're not careful and communicative.
Could backfire.
It could. The key is to find a sustainable balance, understand your negotiating leverage in each situation, and always prioritize maintaining strong, transparent, and fair relationships within your entire business ecosystem: customers, suppliers, employees, lenders. Also remember that the effectiveness and even the cost of some of these strategies can shift during economic downturns.
How so?
Well, for example, your cash-strapped customers might actually be more interested in taking advantage of your early payment discounts if they're also facing cash flow challenges. But remember, that reduces your revenue per sale. Conversely, your leverage for negotiating better payment terms with your suppliers might actually decrease if they are also under significant financial pressure themselves.
And they may be less flexible.
Exactly. And as we've already discussed, access to traditional financing tends to tighten up during downturns, making loans and lines of credit potentially harder to get and more expensive. Even trying to liquidate excess inventory might yield lower returns than usual if overall market demand has dropped. So, businesses really need to be agile. They need to continuously evaluate which strategies are the most appropriate, the most cost-effective, and the most feasible given the current specific economic climate and their own circumstances.
Agility and continuous evaluation seem key. That's a great overview of how to manage cash flow internally by adjusting inflows and outflows. Now, what about when those internal measures just aren't quite enough to bridge a gap? Let's talk about leveraging short-term financing options.
Right. While optimizing your internal cash flow through those strategies we just discussed should always be your first priority, there are definitely times when seeking external financing becomes necessary, especially to bridge temporary gaps caused by unexpected crises, seasonal fluctuations, or during broader economic downturns.
A necessary tool sometimes.
Exactly. But it's really important to view this type of financing as a strategic tool to overcome specific short-term hurdles, not as a permanent fix for underlying persistent cash flow problems in the business model. If you constantly need loans just to make payroll, there's a deeper issue.
Got it. Band-aid, not a cure.
Precisely. And just to reiterate that earlier point, it's always wise to try and establish access to credit facilities, like a line of credit, before you're actually in a crisis situation. Your options will likely be more limited and certainly more expensive when you're perceived as being financially distressed.
Plan ahead. Okay, so what are some common short-term financing options that businesses might consider when they need that temporary cash injection?
One very common and flexible option is a business line of credit, or LOC. We touched on this. This is essentially a flexible revolving credit facility that a lender, usually a bank, provides up to a pre-approved credit limit,
Revolving meaning.
meaning you can draw funds from it as needed, up to your limit, then repay those funds, and then draw them again later if you need to, all without having to go through a new loan application process each time. It's like a credit card for your business, but usually with better terms.
Okay, flexible access. What are some of the main pros and cons of using a business line of credit?
On the plus side, it's excellent for managing those unpredictable short-term ups and downs in your cash flow, covering unexpected expenses that pop up, or bridging the gap while you're waiting for large customer payments to come in, your accounts receivable.
Smoothing out the bumps.
Exactly. And you typically only pay interest on the amount you've actually borrowed, the outstanding balance, not on the entire credit limit that's available to you. Using it responsibly, drawing and repaying regularly can also help you build your business credit score and strengthen your relationship with your lender. And sometimes, especially for established businesses, unsecured lines of credit might be available, meaning you don't have to pledge specific assets as collateral.
Sounds pretty good. What are the downsides or risks?
Well, the interest rates on lines of credit can be variable, meaning they can go up if market rates rise, and they might be higher overall compared to a traditional term loan, especially for unsecured lines or if your business has a weaker credit profile. There can also be various fees involved, origination fees to set it up, sometimes annual maintenance fees, maybe draw fees each time you take money out, and of course, late payment fees.
Got to read the fine print.
Always. And because the funds are so easily accessible, there's a potential risk of overspending or becoming overly reliant on it if you're not disciplined in managing your draws and repayments. Qualifying often requires a reasonably good business credit history and a proven track record. The credit limits might also be lower than what you could potentially get with a secured term loan. And one other thing to be aware of. Some banks have what's called a cleanup provision in their LOC agreements.
A cleanup provision.
Yeah, it might require you to bring the outstanding balance down to zero for a certain period each year, say for 30 consecutive days, just to demonstrate you're not using it as permanent capital. That can be tricky to manage if you rely on it heavily.
That's good to know. Okay, so lines of credit are one option. What's another common short-term financing choice?
Short-term business loans are another possibility. Unlike a revolving line of credit, these provide you with a fixed lump sum of capital upfront. You then repay that amount, plus interest, in regular installments over a relatively short predetermined period, usually ranging from a few months up to maybe a year or two at most.
Fixed amount, fixed term.
Right. They're often used for specific, defined short-term needs, maybe financing a large inventory purchase before a busy season, boosting your working capital temporarily, bridging a known cash flow gap between projects, or maybe taking advantage of an immediate, time-sensitive business opportunity.
What are the advantages and disadvantages of these short-term loans compared to, say, a line of credit?
One of the main benefits is that they can often provide quick access to funds. The approval process can sometimes be faster and might require less extensive documentation compared to longer-term loans or even some lines of credit, especially with online lenders.
Speed might be a factor.
It can be. The eligibility requirements might also be slightly more relaxed in some cases, making them potentially accessible even if your credit history isn't perfect, although the cost will reflect that risk. You generally have flexibility in how you use the funds for various business needs, and repaying the loan on time according to the schedule can definitely help build your business credit profile.
Okay, and the downsides.
The biggest downside is typically the cost. Short-term loans almost always come with higher interest rates and potentially higher fees compared to longer-term loans or sometimes even lines of credit. Lenders need to compensate for the shorter repayment period and often perceive higher risk.
Higher cost for quicker access or maybe easier approval.
That's often the trade-off. Also, because the repayment periods are short, it means you'll have higher and often more frequent payments, sometimes weekly or even daily, with some online lenders. This can put a significant immediate strain on your cash flow if you haven't carefully budgeted for those repayments. The total loan amounts available might also be smaller than what you could get with longer-term financing. And there's a real risk of getting caught in a debt cycle if you find yourself repeatedly needing to take out new short-term loans just to cover operational shortfalls or to make payments on existing loans. That can spiral quickly.
Need to be careful not to dig a deeper hole.
Yeah.
Okay, those are a couple of more traditional options, lines of credit, short-term loans. What about something a little different, like leveraging your outstanding customer invoices themselves?
Yes, that's a really interesting category. Invoice factoring and invoice financing. These can be particularly useful options for businesses that primarily sell to other businesses, B2B, and therefore have significant accounts receivable.
So using the money owed to you to get cash now.
Exactly. Let's break them down. Invoice factoring typically involves selling your outstanding accounts receivable, your unpaid invoices directly to a third-party company called a factor at a discount.
Selling the debt.
Essentially, yes. The factor will usually advance you a large percentage of the invoice's face value almost immediately, maybe 70–90%. Then, once your customer pays the invoice, often directly to the factor will pay you the remaining balance, minus their agreed-upon fee or discount. In many factoring arrangements, the factor actually takes over the responsibility of collecting the payment from your customer.
Okay, that's factoring. What's invoice financing?
Invoice financing is slightly different. It's more like a loan or a line of credit secured by your invoices. Instead of selling the invoices outright, you use them as collateral. The lender advances you cash based on a percentage of the value of your eligible outstanding invoices. You typically remain responsible for collecting the payments from your customers, and as they pay, you use that money to repay the lender.
So financing uses invoices as collateral. Factoring sells them. Got it. What are the pros and cons of this general approach, getting cash against your receivables?
The big advantage for both factoring and financing is that it provides very quick access to the cash that's currently tied up in your unpaid invoices. It directly addresses cash flow problems caused by slow-paying customers.
Unlocks that trapped cash.
Precisely. Another key benefit is that approval is often based more on the creditworthiness of your customers, the companies that owe you money, rather than solely on your own company's credit history or financial standing. This can make it accessible even if your business is relatively new or has a weaker credit profile. And specifically in the case of factoring where you sell the invoice, it's not technically considered debt on your balance sheet, which might be important for loan covenants or future borrowing capacity.
Interesting. What about the downsides? That sounds potentially expensive.
It definitely can be one of the more expensive forms of financing. The discount rate charged by factors or the interest rates and fees charged for invoice financing can be quite high, significantly eating into your profit margins on those sales. You're paying for the speed and convenience.
The cost of getting cash fast.
Right. Another potential drawback, mainly with factoring where the factor interacts with your customer, is the potential negative impact on your customer relationships. Some customers might perceive it negatively if they suddenly have to deal with a third-party collection company, or they might even infer that your business is in financial trouble.
Could damage the relationship.
It's a risk to consider. And finally, these options are generally only suitable for businesses that operate on a B2B model and regularly issue invoices with payment terms. If you're primarily a retail business dealing with consumers paying immediately, this won't work for you.
Makes sense. There are definitely a lot of different avenues to consider for short-term cash needs. Are there any other financing options we should briefly be aware of?
Yes, there are a few others worth mentioning quickly. Asset-based lending, or ABL, is somewhat similar to invoice financing but broader. It involves getting loans or lines of credit that are secured by various company assets, not just receivables, but potentially also your inventory, machinery, or equipment. The amount you can borrow is based on a percentage of the appraised value of those pledged assets.
Using assets as collateral.
Right. We've also already talked about trade credit, simply negotiating extended payment terms with your suppliers. That's essentially a form of short-term, often interest-free financing provided by your vendors. Don't overlook that one.
Good reminder.
Then there's something called a merchant cash advance, or MCA. This is where a provider gives you an upfront lump sum of cash in exchange for purchasing a percentage of your future credit and debit card sales receipts, plus a fee. Repayment happens automatically as a fixed percentage is deducted from your daily card sales until the agreed-upon amount is repaid.
Sounds convenient, but
But it's crucial to understand that the effective interest rates, or factor rates, on MCAs can be extremely high, often reaching triple digits when calculated as an annual percentage rate, APR. They should generally be considered only as a last resort due to their very high cost.
buyer beware on MCAs.
Yeah.
Got it. Any others?
Some businesses also turn to friends and family for loans. This can offer quick access to cash, potentially with more flexible or favorable terms than institutional lenders. However, borrowing from personal connections carries significant risks to those relationships if things go wrong. It's absolutely crucial to formalize any such arrangement with a clear written loan agreement outlining repayment terms, interest, if any, and consequences of default, just like a formal loan.
Keep it businesslike, even with family.
Essential advice. Owners might also consider injecting their own personal savings into the business, and owner infusion. This avoids taking on external debt, but it obviously puts the owner's personal financial security directly at risk.
Personal risk versus business risk.
Exactly. Crowdfunding platforms where you raise small amounts of money from a large number of people online can sometimes be an option, usually for funding specific projects, products, or growth initiatives rather than general working capital. And finally, always keep an eye out for government loan programs or grants, especially during widespread economic crises or for specific types of businesses, like minority-owned or those in certain industries. Organizations like the Small Business Administration, SBA, in the U.S. often offer programs with potentially more favorable terms than commercial lenders, although the application process can sometimes be lengthy and complex. Having pre-existing relationships with SBA-approved lenders can often be helpful in navigating these programs.
Wow, that's a really comprehensive overview of the short-term financing landscape. Lots of options, each with its own trade-offs. And we have a helpful table in our notes that summarizes these different options, highlighting typical use cases, the key pros and cons, and some important considerations specifically for using them during an economic downturn.
Exactly. Choosing the right financing option, if you need one, really comes down to carefully considering your specific needs. How much cash do you need? How urgently do you need it? What's the total cost, including interest and all fees? What's your realistic capacity to repay it on schedule? And what's the potential impact on your customer relationships, your balance sheet, and your long-term financial health? It requires careful thought.
Absolutely. So we've talked extensively about managing the cash you have coming in and going out, and also about potentially getting access to more cash in the short term through financing. But a really key part of effective, proactive cash flow management is looking ahead. Right. Let's move on to the power of cash flow forecasting.
You're absolutely right. While managing your current inflows and outflows daily or weekly is vital for survival, truly effective cash flow management involves looking further down the road, and that's where cash flow forecasting comes in. It's the process of estimating your expected cash inflows and your expected cash outflows over a specific future period, whether that's the next few weeks, the next few months, or even the next year or more.
Predicting the future, basically.
Well, projecting the future is probably a better word. The goal is to predict what your cash position, your bank balance, is likely to be at various points in the future based on reasonable assumptions. And it's really important to remember that a forecast is a projection, an estimate based on the best information you have now. It's not a report of what has already happened, like the historical cash flow statement we discussed earlier.
Future-looking versus backward-looking. Got it. So what exactly is cash flow forecasting in practice, and why is it so essential for a business, especially maybe smaller businesses?
Think of cash flow forecasting as creating a financial roadmap or maybe an early warning system for your business's cash health. Its main purpose is to give you visibility into what the future might hold, financially speaking. This allows you to be proactive in your management rather than just constantly reacting to cash flow crises as they arise.
Moving from reactive to proactive.
Exactly. Regularly preparing and, just as importantly, reviewing these forecasts is really a fundamental aspect of good financial hygiene for any business, regardless of size.
What are some of the key benefits? Why is spending time on this forecasting process so important?
Oh, the benefits are huge. One of the biggest is that it allows you to anticipate potential future periods where your cash outflows might exceed your inflows, potentially leading to a dangerous cash shortfall.
Seeing trouble coming.
Right. This foresight gives you precious time to plan ahead. Maybe you need to arrange a line of credit before you need it, or maybe you need to delay some non-essential expenses, or perhaps really step up your collection efforts on outstanding invoices. It helps you avoid that sudden panic when payroll is due and the bank account is empty.
Avoid the crisis moment.
Definitely. Conversely, forecasting can also help you identify periods where you might have a significant surplus of cash building up. Knowing this allows you to plan strategically for how to best use that excess cash, maybe pay down high-interest debt faster, make a strategic investment you've been considering, or build up your emergency reserve.
Puts you in control of surpluses, too.
Yes. Forecasts also provide crucial data you need to make smarter, more informed, strategic decisions about the future of your business decisions, about investments in new equipment, hiring new staff, expanding into new markets. Is the cash likely to be there to support those initiatives?
Connect strategy to financial reality.
Perfectly put. They're also an integral part of your overall planning and budgeting process, helping you make sure your planned spending aligns with your strategic goals and your realistically available cash resources. And as we touched on with financing, if you ever need to seek funding from lenders or investors, they will almost certainly want to see your cash flow forecast as part of their due diligence process. They want to see you're managing proactively.
Shows you on top of things.
It does. Forecasting also directly helps you manage your working capital, that difference between your current assets and current liabilities, and your overall liquidity, ensuring you have enough cash on hand to meet your short-term obligations as they come due. And finally, it's an incredibly valuable tool for risk management and scenario planning.
What do you mean by scenario planning?
You can use your forecast model to run different what-if scenarios. What happens to our cash position if sales suddenly drop by 15% for 3 months? What if a major supplier increases their prices by 10%? What if interest rates go up another point?
Stress testing your finances.
Exactly. Modeling these different potential futures allows you to prepare contingency plans in advance and make your business much more resilient, especially when there's a lot of economic uncertainty swirling around.
It really sounds like forecasting shifts cash flow management from being purely reactive, putting out fires, to being much more proactive, strategic, and forward-looking. Reduces surprises.
That's the core benefit. It reduces uncertainty and provides that critical lead time you need to make necessary adjustments before small problems become major crises.
Okay, I'm sold on the importance. So how does a business actually go about creating a basic cash flow forecast? Does it require complex software?
While there is sophisticated forecasting software available, you can absolutely start, and many businesses continue, with a basic but effective cash flow forecast using a simple spreadsheet program like Excel or Google Sheets. The key steps involve systematically projecting your expected inflows and outflows over a chosen period.
What's the first step?
First, you need to decide on your forecast period or time horizon. Are you looking ahead for the next 13 weeks, the next 6 months, the full next year? And then, how detailed do you need it to be? Will you forecast daily, weekly, or monthly cash flows?
Does the choice depend on the goal?
Generally, yes. Shorter-term forecasts, like a rolling 13-week forecast updated weekly, are usually best for managing your immediate liquidity needs, making sure you can cover payroll next week. Longer-term forecasts, say for 6 or 12 months, broken down monthly, are more aligned with your strategic planning, budgeting, and maybe identifying needs for larger financing down the road. Many businesses use a rolling forecast, constantly updating it and extending it further into the future.
Okay, choose the period and frequency. What's next?
Next, you need to determine your opening cash balance. This is simply the actual amount of cash and cash equivalents, checking accounts, savings, money market funds your business has readily available at the very beginning of your forecast period. Get this starting point right.
Your starting cash position. Got it.
Then, the real work begins. Estimating all your expected cash inflows for each subperiod, greater than G, each week or month, within your forecast horizon.
Where does this inflow information come from?
It comes from various sources. You'll project your expected cash sales. You'll estimate the cash you expect to collect from your existing and future accounts receivable. This requires looking at your sales forecasts, your typical customer payment patterns and history, and your payment terms. You'll include any loan proceeds you anticipate receiving during the period, any cash expected from selling assets or investments, and any other sources of cash like grants, tax refunds, or maybe planned contributions from the donors.
Need inputs from sales, maybe operations.
Definitely requires collaboration. And a key piece of advice here: it's generally better to be conservative or realistic in your sales and collection projections rather than overly optimistic. Factor in things like seasonality if it affects your business, and consider the current economic conditions. Are things booming or slowing down?
Better to be pleasantly surprised than unpleasantly shocked.
Exactly. Underpromise and overdeliver on your cash forecast if you can.
Okay, so that's projecting the cash coming in, then we project the cash going out.
Precisely. You need to estimate all the cash payments you expect to make during each sub-period. This is often a bit easier to predict than inflows for recurring expenses. Think about payments to your suppliers for inventory and services. Consider your payment terms with them. Estimate your payroll costs, including salaries, wages, payroll taxes, and benefits. Factor in your fixed costs like rent, utilities, and insurance payments.
Regular bills.
Right. Include any scheduled loan principal and interest payments. Estimate your upcoming tax payments, income tax, sales tax, etc. Plan for any anticipated capital expenditures buying that new piece of equipment. And budget for your other variable operating expenses like marketing, travel, office supplies.
Don't forget anything.
Try not to. Crucially, account for the timing of these payments based on their actual due dates. And remember to include less frequent but potentially significant payments like annual insurance premiums or quarterly tax installments in the correct period. It's also often wise to build in a small buffer or contingency line item for unexpected expenses that inevitably arise.
A little cushion for surprises. Makes sense.
Thanks.
So once we have all those inflow estimates and outflow estimates for each period, how do we actually get to the final forecast numbers?
It's straightforward arithmetic from there. For each period in your forecast, each week or month, you'll calculate your net cash flow for that period by simply subtracting your total estimated cash outflows from your total estimated cash inflows.
Inflows minus outflows equals net change.
Exactly. Then you'll calculate your closing cash balance for that period. You do this by taking the opening cash balance for that period and adding the net cash flow, which could be positive or negative, that you just calculated.
Opening balance plus net change equals closing balance.
You got it. And here's the key link. The closing cash balance for one period then becomes the opening cash balance for the very next period in your forecast. You just continue this calculation, rolling it forward for the entire duration of your forecast. Using spreadsheet software makes these calculations automatic and really helps with updating the forecast easily as your estimates or actuals change.
I can see how a spreadsheet would be essential for this.
Sure.
Okay, you mentioned earlier there are different methods for cash flow forecasting. Can you give us a quick overview of the main ones? Direct versus indirect.
Yes, there are two primary methods used, and they approach forecasting from different angles: the direct method and the indirect method.
Let's start with the direct method. What's that involve?
The direct method, which is sometimes called the receipts and disbursements method, is very intuitive. It forecasts your cash flow by directly estimating the actual categories of cash you expect to receive, like cash from customers, interest received, and the actual categories of cash you expect to pay out, like payments to suppliers, salaries paid, taxes paid, during the period. It really focuses on tracking the anticipated movement of cash through your bank accounts.
Sounds like what we just described building in a spreadsheet.
It basically is. The advantage of the direct method is that it gives you a very clear, detailed, and easy to understand picture of your actual expected cash movements. This makes it highly accurate and very useful for short-term liquidity management, managing your cash day to day or week to week, and for operational planning. It's also often easier for people who aren't accountants by training to grasp.
Makes sense. What are the downsides of the direct method?
The main disadvantage is that it can be quite time-consuming to prepare, especially for complex businesses with many transaction types. It requires gathering very detailed forecasts and data about specific expected receipts and payments. Because of this detail, it's also generally less suitable for longer-term strategic forecasting. Accurately predicting specific cash transactions months or years into the future is very difficult.
Hard to know exactly when that specific customer will pay 9 months from now.
Exactly. The uncertainty increases significantly over longer time horizons.
Okay, so that's the direct method, detailed, good for short term, but maybe time consuming. What about the indirect method? How does that work?
The indirect method takes a different starting point. It begins with your projected net income, your profit, from your forecasted income statement. It then adjusts that net income figure for two main things. First, any non-cash items that were included in calculating net income, like depreciation and amortization. And second, the expected changes in your working capital accounts on your balance sheet, like accounts receivable, inventory, and accounts payable.
So it works backward from profit.
Kind of. These adjustments essentially reconcile your accrual-based net income back to your estimated operating cash flow. You then separately add in your projected cash flows from investing activities like CapEx and financing activities like loan proceeds or repayments to arrive at the total projected change in cash.
Why use this method? What are the advantages?
The main advantage of the indirect method is that it's generally easier and faster to prepare, especially if you already have standard projected financial statements, income statement, and balance sheet created for your budgeting or planning process. It uses data that's often more readily available. It also clearly links your projected cash flow back to your projected profitability and balance sheet changes, which can be very useful for understanding the drivers of cash flow and for longer-term strategic planning and analysis. In fact, the indirect method is the format most commonly required and used for the official cash flow statement prepared under accounting standards like GAAP.
Okay, faster, uses standard financials, good for long term. What are the disadvantages of the indirect method?
The main drawback is that it's less intuitive. It doesn't directly track the actual flow of cash receipts and payments, so it can be harder to visualize exactly where the cash is coming from and going to on a day-to-day basis. Its accuracy also really depends heavily on the accuracy of your underlying net income and balance sheet projections. And because it starts at a higher level, it provides less granular detail about specific cash inflows and outflows, making it generally less helpful for very short-term tactical cash management compared to the direct method.
So, different methods for different purposes. Do businesses typically choose one or the other?
Many businesses actually use a combination of both methods. They might use the detailed direct method for their critical short-term operational cash management, maybe that rolling 13-week forecast we talked about, focused on exactly when cash will hit the bank. And then they might use the indirect method for their longer-term strategic planning, annual budgeting, and for preparing their formal financial statements.
That makes sense, using the right tool for the right job. Now, once you have a forecast, whichever method you used, what do you do with it? It's not just about creating the document and filing it away, is it?
Absolutely not. Creating the forecast is really just the first step. Its true power and value come from regularly, consistently comparing your forecast to what actually happens in your business. This crucial process is called variance analysis.
Variance analysis. Okay, what does that involve?
Variance analysis is simply the process of comparing your forecasted figures, what you thought would happen, against your actual results for the same period, what did happen, to identify, quantify, and most importantly, understand any differences. These differences are called variances.
Makes sense. Forecast versus actual.
Right. And a variance can be favorable or unfavorable. A favorable variance is when your actual results are better than what you forecasted, for example. Maybe your cash inflows were higher than expected, or your cash outflows were lower. An unfavorable variance is the opposite. Maybe inflows were lower, or outflows were higher than you predicted.
Okay, and why is doing this comparison, this variance analysis, so important? What do you learn from it?
Comparing your actual cash flows to your forecast provides several absolutely critical benefits for managing your business. First, it helps you understand your actual performance much better. Why did your actual cash flow differ from what you were expecting? Was it because sales were lower than anticipated? Did customers pay slower than you assumed? Were supplier costs unexpectedly high? Did a planned project get pushed back, affecting outflows? It helps you diagnose the reasons.
Pinpointing the cause of the difference.
Exactly. Second, variance analysis helps you identify any inaccuracies or flaws in your original forecasting assumptions or methodology. For example, if you consistently find that you underestimated your utility costs month after month, that tells you clearly that you need to revise that specific assumption for your future forecasts.
Learning from mistakes in the forecast.
Precisely. Significant or recurring variances can also act as warning signals, pointing to potential underlying operational issues in your business that need attention. Maybe consistently slow collections point to problems in your invoicing or follow-up process. Maybe high inventory costs signal poor purchasing or stocking decisions. Or perhaps cost overruns in a particular department indicate a need for tighter budget controls there.
Uncovering operational problems.
Yes, and by understanding the reasons behind your past variances, you can continuously refine your assumptions and improve your forecasting methods, leading to more accurate and reliable forecasts in the future. It's a continuous cycle of learning and improvement. And perhaps most importantly, variance analysis gives you the timely feedback you need to make necessary adjustments to your business strategy, your operational plans, and your budgets before it's too late.
So it drives action.
It absolutely should. If your cash inflows are consistently coming in lower than you forecasted, maybe you need to shift your marketing focus, adjust your pricing, or implement more aggressive collection tactics. If your outflows are consistently higher in a certain area, maybe you need to implement stricter expense controls, renegotiate with specific suppliers, or find operational efficiencies. It allows you to course correct based on real data.
So it really is an ongoing loop.
Yeah.
You forecast, you execute your plans, you monitor the actual results, you analyze the variance between forecast and actual, and then you adjust your forecasts and your plans based on what you learned.
Exactly. That's the perfect summary. Effective cash flow management is an iterative cycle. Forecast, execute, monitor, analyze variance, adjust, and repeat. This continuous loop is absolutely vital for maintaining financial control and building resilience, especially when you're operating in an uncertain economic environment.
And I guess the quality of the forecast, and therefore the variance analysis, really depends on the quality of the information going into it.
Absolutely. Garbage in, garbage out applies here too. The accuracy of your forecasting fundamentally relies on the quality and realism of the inputs and assumptions you use, realistic sales projections from your sales team, accurate estimates of customer collection times based on history, precise cost data from operations, a good understanding of supplier payment cycles from procurement or finance.
Requires good communication across the company.
It really does. It often requires strong interdepartmental communication and data sharing. Your sales team needs to provide reliable information about the sales pipeline. Your operations team needs to accurately estimate production costs and timing. Your finance team needs to understand customer payment behaviors and banking timelines. Variance analysis then helps you pinpoint which of these inputs or underlying assumptions were off the mark, allowing you to have targeted conversations and make focused improvements in your data gathering, your assumptions, and your cross-functional collaboration efforts for the next forecast cycle.
This has been such a comprehensive and I think really practical deep dive into the world of cash flow management. Let's try and wrap things up with some key takeaways for everyone listening.
Absolutely. Happy to. For anyone looking to build a solid understanding of business finance, whether you're a student, an entrepreneur, or working within a larger company, especially thinking about today's economic climate, there are definitely a few critical concepts about cash flow to really internalize.
Okay, what's takeaway number one?
First, and maybe foremost, cash flow is king. Remember that it's distinct, very distinct from counting profit and revenue. Positive cash flow isn't just nice to have. It's absolutely essential for a business's day-to-day operations and its long-term survival, particularly when the economy takes a downturn. Don't get fooled by profit figures alone.
Cash is king. Got it. Number
Yeah.
two.
Second, make sure you understand the components. Know the three main sections of the cash flow statement: operating, investing, and financing activities, and recognize how each tells a different part of your company's financial story. Pay particular attention to operating cash flow, OCF, as it's really the most critical indicator of whether the core business itself is sustainable and generating the cash needed.
Know the three pillars, especially OCF.
Okay, third,
Third, be acutely aware that economic downturns and recessions significantly amplify existing cash flow challenges. Expect potential impacts like reduced sales, slower customer payments, tighter access to credit, and possibly increasing costs. These pressures make effective, proactive cash flow management even more crucial during tough times.
downturns raise the stakes. Makes sense. Fourth takeaway. Fourth, start mastering the strategies. Familiarize yourself with the practical techniques for managing cash flow that we discussed. Learn how to actively work to accelerate your cash inflows, getting paid faster. Understand how to strategically control your cash outflow spending smarter. And know when and how to use short-term financing options judiciously and appropriately if they become necessary. Have a toolkit ready.
Master the strategies, inflows, outflows, financing. And
Finally, embrace the power of looking ahead through forecasting and monitoring. Understand why cash flow forecasting is so valuable for anticipating future needs and potential challenges. Learn the basic steps involved in creating a forecast and know the difference between the direct and indirect methods. And crucially, remember that your forecasts aren't static documents. You need to continuously compare them against your actual results through variance analysis to refine your assumptions, learn from differences, and adapt your strategies proactively as needed.
forecast and monitor continuously. Great summary. And it really sounds like this isn't a one-time fix or something you only do when there's a crisis. It's an ongoing discipline.
That's exactly right. Effective cash flow management is truly a dynamic and continuous process. It's not a project with an end date. It requires constant vigilance, regular analysis of your performance compared to your plans and forecasts, and a fundamental willingness and ability to adapt your strategies quickly in response to both what's happening internally within your business and any changes unfolding in the external economic environment.
Constant attention and adaptation.
Yes, and businesses that can successfully cultivate this capability, that manage to integrate a strong financial understanding with operational awareness and strategic foresight, are the ones that build true, lasting financial resilience. This resilience will not only help them navigate and weather economic storms and periods of high uncertainty, but it can also potentially allow them to identify and seize opportunities that might arise when their less prepared competitors are struggling.
Turning challenge into opportunity, potentially.
It's possible. Ultimately, mastering the flow of cash, understanding it, forecasting it, managing it is absolutely fundamental to ensuring a business can not only survive challenges, but also sustain itself and hopefully thrive for the long haul. For anyone listening, whether you plan to start your own business or work within finance or management, developing a strong understanding and practical skills in cash flow management will be an incredibly invaluable asset throughout your entire career.
That's a fantastic summary and a great note to end on. And maybe for our final provocative thought today, something for you, the listener, to consider. Think about how different types of business models inherently face different kinds of cash flow challenges. For example, compare a software as a service business with recurring monthly revenue versus a construction company with long project cycles and milestone payments. Or a retailer with high inventory turnover versus a manufacturer with complex supply chains. How might their cash flow patterns differ? And how would proactive management strategies need to be tailored to mitigate those specific inherent risks? Understanding those nuances can be key to building that long-term financial resilience we talked about.
Great point to ponder.
Thanks for joining us for this deep dive into the critical world of business cash flow.